Is all this churn creating a lasting leadership shift for the market? And what does it say about the path ahead for the economy? Here to take on these questions is Jim Caron of Morgan Stanley Investment Management. Jim, it's good to see you.
Yeah, it's good to see you.
So in your view, what is the market trying to express here? How are we kind of repositioning for this new environment?
Okay, so there's a couple of things that are taking place. When we started last year, we thought about tariffs, taxes, and deregulation, right? We got tariffs right out of the gates. Now we're seeing the benefit of the One Big Beautiful Bill Act, the taxes, and also the deregulation. To me, this is the big driver of the broadening of the market and the cyclical leadership that we're seeing. And I think it's going to be very, very durable because these are structural forces that are here to stay. But talking about the structure and the structural forces, we are going through immense structural changes right now that you see maybe one or two times in a century. And this puts a lot of money in motion. We're seeing it. Foreign policy, tariffs, trade, everything's being renegotiated. And this creates four very important themes for us to invest in. The first one's deglobalization. The second one is reindustrialization. So if you're not going to buy stuff from China, you have to make it at home. And you're seeing that not only in the U.S., but also in Europe, onshoring. Third is technological innovations, so we're going to be smart about how we reindustrialize. And the fourth is how we fund all of this stuff, how we pay for it. And a lot of this is really coming through fiscal policy, what I call state capitalism. Fiscal policy, deregulation, in addition to like your standard stocks, IPOs, bonds, and private markets. But all of this is creating a broadening because there are going to be winners and losers. There's going to be creative destruction, which creates the winners and losers. And this is what gives us an opportunity to think more thematically about markets, and that's why they're going to broaden.
So as you lay that out, I mean, I can think of a few implications if we're just going to look inside the market and say how this is influencing things. Obviously, I mean, industrials as a group have been very strong. So that kind of reindustrialization as well as the building of the, I guess, the AI future is part of that story. But I could also look at commodities and say that's a deglobalization story in a way. Everyone's kind of stockpiling and scarce resource. What does it mean more broadly for either the pace of overall economic growth or I guess inflation, and whether it's going to be a stickier kind of high nominal growth world for a while, or any of those macro implications?
Yeah, so the inflation aspect of this is we have to really start to think about the productivity, right? So we are getting a boost to productivity, so that should help. Right now, labor is in a soft spot primarily because of the tariffs. The labor is the lagged effect of the tariffs. So everybody thought that tariffs were going to create inflation, and right now we're not really seeing that. But what tariffs did do is they did soften the labor market as companies braced for higher prices and they reduced labor. But all of that's going to start to fade away starting in the middle of this year. So I do think that labor starts to come back. But inflation with higher productivity and all this capex and investment should be there. Now, ultimately speaking, you know, if we think about the Fed and we think about policy and we think about the just the broader context of inflation, sure, it's always a risk. But right now, I think we're in kind of a sweet spot. We're not seeing it.
Yeah, I mean, obviously, the bond market's not really expressing a lot of concern about longer-term inflation. The dollar is kind of in the middle of a 6-month range. So all the things you might look at to say, okay, something's getting out of balance is not really evident right now. As you invest alongside these themes, where does the AI trade as it's been defined fit in?
All right, so it's a great question because where we think it fits in is really, oddly enough, it's in the value sectors of the markets.
Okay.
Odd, right? Because what AI is going to do for companies that adopt new technology, what they're going to do is become more efficient, more productive, and you're going to unlock a lot of economic value. And these are better priced stocks, better valued stocks, parts of the markets that actually have a lot more upside. Healthcare is one of those. Very inefficient sector. Right? You start to adopt AI technology just in terms of how their business practices go, you get a lot of operating leverage out of that. You're seeing it in things like Caterpillar, the #1 stock in the Dow, right? It's a construction company, but they're building the data centers and they're using AI to run their machinery better and more efficiently. Again, more operating leverage. So therefore, you can screen for these things and you can build baskets of equities, which is what we're doing, a policy basket, a deregulation basket, a defense basket, an AI basket, and actually create a thematic portfolio, and that's our approach.